Everyone, dear guests, faculty, alumni, students, and friends, welcome to ITAM. Welcome to the 5th Finance Conference, sponsored by Fundef, la Fundación de Estudios Financieros. My name is Francisco Pérez González, and I'm the Dean of the Business Degree Programs at ITAM. For those that are visiting, since our foundation 70 years ago, ITAM's objective is to promote high-quality education and research to empower the members of our community to promote a more developed, free, and just world. To achieve this mission, ITAM has a long tradition of seeking to recruit from the international markets some of the most qualified academics in their respective fields. As a student here at ITAM over 20 years ago, I had the luxury of taking courses from newly minted PhDs from world-renowned institutions such as Harvard, Stanford, Chicago, MIT, Princeton, Yale, Columbia, among many other institutions. The lessons of cohorts of influential professors not only inspired me and many others from our institution to pursue graduate degrees abroad, but crucially also have guided and continue to guide the development of many important economic and financial institutions in our country. In recent years, ITAM has invested heavily in making its transformation from a primarily teaching-oriented institution a generation ago to building the basis of a strong research-oriented culture. We firmly believe that we cannot be the leaders in business or finance education in Mexico and in Latin America without a research mindset, without systematically searching for new knowledge, challenging the status quo, and discovering new facts or principles. The challenges facing the world, and in particular the emerging world, require fresh insights that research can help uncover. Now, with that perspective in mind, and zooming into the finance domain, we're here to kick off the 5th ITAM Finance Conference. Now, I want to start by thanking Guillermo Samarripa, Jorge Sanchez, and everyone from Fundef, la Fundación de Estudios Financieros, for their financial support. Without Fundef's generous support, this international conference would not be what it is. So, thank you. I also want to publicly recognize Renata Herrerías, Alfredo Ibáñez, and in particular, Aurelio Vázquez, for putting together this conference. Great work. Fundef and Aurelio are the two strong pillars supporting this finance conference since its inceptions a few years ago. So this finance conference is part of a large institutional commitment to finance research at ITAM. We believe we're the leaders in organizing these international finance conferences, and I'm thrilled also to announce that in 2017 we will host the first ever meeting in Latin America of the Financial Management Association meetings. So we hope to see you back in Mexico this coming February. Now, as you could tell, we're also looking forward to spearhead the finance research initiatives in the Latin American region. From our end, Renata Herrerías from ITAM and Fernando Zapatero from USC are leading the FMA Latin American initiative. Back to the program. So the 2016 program includes sessions on cutting-edge research on relevant topics such as investment strategies and investment management, banking, corporate finance, asset pricing, among others. The sessions combine theory and rigorous empirical analysis to motivate deep discussions among participants. We really hope that you find the sessions both productive and thought-provoking. Last but not least, I want to introduce our speaker, Andrea Frazzini. Andrea is a principal on AQR's global stock selection team, focusing on research and portfolio management on the firm's short and long-only equity strategies. Andrea is also an adjunct professor of finance at the Stern School of Business at NYU University. He's published in top academic journals such as the Journal of Finance, Journal of Political Economy, Journal of Financial Economics, among others. He has won many research awards such as the Smith-Breeden Award, the FAMA DFA Award, the BGI Best Paper Award, among many others accolades. Prior to AQR, Andrea was a finance professor at the University of Chicago Graduate School of Business, now Booth, and he was a research associate at the National Bureau of Economic Research. Andrea earned a bachelor's in economics from the University of Rome, Tre, a master's in economics from the LSE in London, and a PhD in economics from Yale. In my opinion, I know I have the luxury of knowing Andrea personally. Andrea's research is particularly insightful for two reasons. First, his unique innovation and creativity. Second, his focus on relevance and implementation. When we invited Andrea to be our keynote speaker, we thought of his unique insight and perspective about the intersection between research and practice. Needless to say, we teach several of his papers here at ITAM, both at the undergraduate and master's programs. His focus on practice and relevance induces us to preempt the title of his presentation with the following question: how do you turn research ideas into profitable trading strategies? So today, Andrea Frazzini will present two answers: the low beta anomaly and quality low risk investing. So with no further ado, please welcome Andrea Frazzini from AQR Capital Management.
Great, thanks a lot for having me here. Thanks for the awesome introduction, Francisco, just too kind. So as it said, today I want to talk a little bit about it's sort of a very old strain of research that dates all the way back to the 1960s, actually, due to Fisher-Black. And I want to talk about how that's related to actual large portfolios that are run in practice in a wide variety of asset classes, not just by us at AQR, but by lots of other sort of money management firms. So here's the plan for today. I want to give you a little bit of a research background and go back literally to the 1960s and talk a little bit about leverage aversion and the low risk anomaly in particular, about this guy over here, Fisher-Black. And then I also wanted to take a little bit of detour and also talk about one of the most successful investors ever to live, still alive, which is Warren Buffett. And you'll see in a minute why are these sort of two topics related. I want to talk a little bit about the track record of Warren Buffett, his leverage, decompose his return, and talk about the sources of returns. They seem very, very sort of disjoint topics. In a minute, you'll see they're actually very, very related. I want to talk about how do we view his returns based on that theory that you have up there. OK, so again, let's go back to the 1960s, to a very particular day, which is, according to Fisher-Black's biography, it's known as the day Alpha died. Or at least that's how Fisher-Black and Myron Scholes talked about it. So in 1969, Fisher-Black and Myron Scholes were consulting for Wells Fargo for a quant group in San Francisco for the creation of a fund. It was called the Stagecoach Fund. And that's sort of an important fund because it's the very first index fund ever launched. It was launched in 1969. It's a buy and hold index fund. It's still in existence. It's sort of the very first practical expression of the CAPM that tells you that the best thing that you want to do is buy and hold the entire market. In consulting for them, they found that low beta stocks had returns that are a little too high relative to what the CAPM would predict, and high beta stocks had returns that are a little too low, an anomaly that's now known as the low beta anomaly. And they advised Wells Fargo to take advantage of it. Particularly, they told Wells Fargo, look, instead of cap weighting your index, low beta stocks have about the same returns as high beta stocks, but lower risk. I'll show you the returns in a minute. What you should do is you should overweight safer securities in the index and then use a little bit of leverage to have the same volatility as the underlying market. You will get a portfolio that has the same amount of market risk, but it's more efficient and has a little higher return. Eventually, Wells Fargo decided not to do it. And the story goes that Fisher-Black actually stormed out of the room. He was a very calm person. This, again, according to his biography, it was the only time that people have seen Fisher actually upset in public. And so this simple observation turns out to be one of the most remarkable asset pricing anomaly that we know in financial economics. And by remarkable, I really mean by in terms of size. It's just very big. And I'll show you the numbers in a minute. And the remarkable in terms of persistence. Again, this is 1969. And most of what we're going to show you today, it's literally out of sample. It's looking at data subsequent to that period in many asset classes that actually were not used in the individual study. And Fisher-Black was the first one to conjecture that maybe the reason why low beta stocks and high beta stocks don't have very different returns, that could be something to do with borrowing constraint. And in fact, the real reason Wells Fargo put up for not trading on this anomaly was the fact that they were having a hard time marketing the Stagecoach Fund. They basically said, this is a new concept. Remember, this is 1969, so there were no index fund. The buy and hold the entire index was a revolutionary idea at the time. It said if we add some leverage to it, the public would just consider it too esoteric. We already have a hard time marketing this. We just don't want to add complication. So despite the fact that this looks great, we actually are not, don't want to do it. And Fisher-Black was the first one to conjecture that some investors, just like Wells Fargo, that are unwilling to borrow or lever it or can lever it for some other reason, are actually the one causing this particular anomaly. If they're big enough, they can actually distort prices in a large scale. So let me give you a modern depiction of the low beta anomaly. So this picture is the aggregate US stock market. This is the entire market for the 1920s to now, simply split in 10 portfolios sorted on betas. From low beta stocks to the left to high beta stocks to the right. Everything is cap weighted, so this literally sums up to the entire market. So the green bar shows you volatility of those portfolios. Not surprising, low beta stocks have low volatility, high beta stocks at high volatilities. The blue bar shows you average returns of those portfolios. And as you can see, over the longest time series that we have for the larger cross-section of equities, we don't have a lot of evidence that riskier securities and safe securities have had very different rate of return. In fact, the return would have been about the same. What it really means is, remember, this sums up to the entire market. So if you're building an index fund, if you had simply overweight the left side of this graph and underweight or didn't buy the right side of the graph, you would have about the same average return at a lower volatility. And this is what the low beta anomaly is. The fact that riskier and safe securities have rate of return, they're very, very similar. Okay, so let's go back to the story. So who are these people working at Wells Fargo? Well, the team of Quanta was developing the fund was sort of what I consider the dream team of empirical finance back then. This was Fisher-Black, Myron Schultz, David Booth, now named University of Chicago, Vasicek, McQuan, Wade Wagner, the chairman of the Plexus Group. Those are essentially people that created things that we give for granted in finance. They created the first index fund. They created the first repo transaction. They created what's called sunshine trading, which is essentially the way DFA, one of the largest competitors of ours, actually does trade. And the reason, again, they decided not to do it was that it actually did require leverage. You have to actually lever this portfolio in order to take advantage of this anomaly. So a few years ago, I was giving a talk on the West Coast, and one of these guys came up to me and actually said that I still have the original documents from the research department back in Wells Fargo in the 60s. Would you like to see it? And obviously, we're very interested in this. And the next thing I know, a huge box come to my office, not just with copies. This is the original entire documents. And what's cool about those documents is they had to sign. Who was actually in the room discussing those papers. So you have a scan of one of those documents there. You get to see Fisher-Black, Myron Schultz, David Booth, and all these guys. They have to sort of check and tell you what's discussing. I don't know if you guys can read this, but this is a scan of one of those documents. What this is a back test. It says that low risk portfolio levered to market risk, July 1945 to June 1970s. This is a back test of a portfolio that again buys lower beta securities and levers her up to the same level of the market. This is dated March 19, 1971. So this is more than 45 years old. It's something which is very rare in finance. It is most of what we're going to show you now, and what we do actually in actual portfolio. It's essentially this. We have bells and whistles. We do it in many asset classes, but it's not that different from this. So this is one of the rare examples for which we get to play with about 45 years worth of truly out-of-sample data. This is the definition of out-of-sample. This is using US stock market between the 1940s to the 1960s. We're going to look at data outside of the US stock market in periods subsequent to the 1970s. Again, almost a true out-of-sample test of this underlying idea. Okay, so going back to the story, this is 1969. The funds get launched. Black and Schultz try to market this to some other people. No one wants to do it. Eventually, they publish a paper. So in 1972, Fisher-Black, Myron Schultz, and Mike Jensen published one of the most cited papers in financial economics, which is really the very first test of the CAPM. It's the very first time people empirically have tried to test the CAPM. The following year, in 1973, Fisher-Black published a theory paper that essentially underlined the underlying theory of why do we see this, and I'll show you some example. And so the idea is really from Fisher-Black. Fisher-Black passed away, unfortunately, before he could ever test that hypothesis. So he has a paper in 1973, and has a subsequent paper in 1992, but no one has actually taken that hypothesis to the data. Again, the way you test theories. You have to look out of sample. We look at other prediction that is not just what the theory is supposed to match. So in a series of papers with lots of different co-authors, essentially this is what we did. That is, the idea, the model, it's from Fisher-Black. All we have done is we derived some extra prediction, and we tested those predictions in lots of different markets. And in particular, there's 5 key predictions of this underlying idea. I'm going to give you one example. But basically, the first prediction is securities that are safer, that have lower beta, should actually earn higher return than securities that are riskier after accounting for market risk. So high beta stocks should have low alpha, low beta stocks should have high alphas. And since this is related to how much people are willing or unwilling to borrow, borrowing constraint or the number of people that are constrained will affect returns on those securities, so you can take prediction of that. And then a third important prediction is that investors that are leverage constrained should hold lower beta securities and not use leverage, and investors who are leverage constrained should actually take the other side and actually use leverage. So let me just do this with an example, and then you'll see this in practice. So this is a picture of the traditional security market line. This is what everybody gets taught in undergraduate and graduate school. You guys all know this. Risky asset, tangency portfolio. So the two-fund money separation theorem says you should move up and down on this line. Pretty straightforward. Now, let's assume that in the world there are some investors, I'm going to call it the Franciscos of the world, that are not allowed to lever. So who are they in the real world? In the US, for example, the majority of mutual funds self-impose a borrowing constraint, no leverage, no derivatives, despite the fact there is nothing that prevents them from levering and borrowing. The 1948 Act doesn't preclude the use of leverage. It poses some coverage limit on how much leverage, but you can preferably leverage a mutual fund. Many mutual fund providers like us do lever. Or maybe it's an investor just like Wells Fargo that could lever but decides not to do it for other reason. And suppose for a moment that Francisco wants a very high risk. He wants a beta of 2. Let's just make a ridiculous example. And the rest of the world is Frazzini. And the difference between me and Francisco is I can lever. I cannot lever an infinite amount. I borrowing constraints. I have collateral requirements. But if you give me $1, I can borrow a little more and put that into securities. And so Finance 101 says that Francisco, what he should do is should simply borrow $1 and lever it up the tangency portfolio, and that's how he'll get a beta of 2. But Francisco cannot lever. And therefore, but what he could do is he could buy very high beta stocks. He's not going to get a beta of 2, but he can get a beta closer, higher than 1, by overweighting higher beta securities. In doing that, he'll get higher return. He's taking a little more risk. But he's taking more risk by concentrating in risky security rather than by levering. Now, where is the trick? So all I did, I split the world into the people that cannot borrow and the people that can. So what that means is if you take Francisco's holding and sum it up with my holdings, well, we have to sum up to the cap-weighted benchmark. That's just a mathematical fact. Stocks are in positive net supply. So what that means is the only way that Francisco can overweight the higher beta of securities, I have to sell it to him. And the only reason that he can underweight lower beta safer securities, he needs to buy them from me. So in order for markets to clear, prices have to adjust in order to make that happen. Let me just restate this with one sentence. If there is someone out there that cannot lever, they only have one way of taking higher risk. It's by buying more risky stuff, stocks, bonds, whatever. Somebody must be selling those securities to them, and therefore prices have to adjust in order to make that happen. That's essentially the underlying hypothesis. Very simple. But as I said, this generates lots of different predictions. Prediction number 1 is, as the Franciscos of the world have to purchase high beta assets from me, those prices have to rise, so the expected return of those assets has to fall, flattening the security market line. That's a main prediction. That was right there in Fisher-Black's original work. It's sort of still true in the paper. But there's other additional prediction. And I could talk about a few, but let me talk about the one that really is going to get us to Buffett. So think for a second, forget about returns, and think about holdings. And suppose that at some point in this world, you get to see my portfolio and you get to see Francisco's portfolios. Maybe there is some regulatory requirement, so we have to file holdings. I commit fraud. You get to see what portfolio in the court proceeding. You get to see what portfolio. Somehow you get to figure out what I bought and sold or what he bought and sold. Well, you should see for the Franciscos of the world buying the higher beta, riskier asset and not levering. And you should see the Frazzinis of the world taking the other side, that is buying the lower beta assets and selling him the high beta asset and possibly using leverage in order to take advantage of him. And again, I'll show you, we're going to test that. I'm going to show you some ideas. Again, there's lots of other powerful prediction of this theory, but I don't want to go too much into it. Let me just tell you another one. So suppose there are lots of Franciscos of the world out there. So again, what do they want? They want a beta of 2, but they can't lever, so they're going to buy a riskier asset. Well, eventually, financial innovation is going to react to this, and is going to create a security that does the levering for them, and is going to try to sell them to them at a high price. And that business exists. It's called the levered ETF business. The only reason why people buy a 2 times beta levered ETF is because they can't or they are unwilling to buy the 1 times levered ETF, the unlevered ETF, and lever themselves sort of to the 1. And the fees on the 2 times beta ETF are much higher than 2 times the fees of the 1 beta ETF. Again, I'm going to show you some evidence consistent with this idea. But think of it as you can sort of push this theory in lots of different directions and actually go out and test it. OK, so let's just test that and show you first prediction. So the first prediction is you have the math there from one of the papers, but forget about the math. What I said before, the Franciscos of the world are going to try to buy higher beta securities. Their price will rise. The security market line is going to flatten. That's what the prediction is. That is, higher beta stocks should have a higher price, low return. Lower beta stocks should have a lower price, low return. So this is the standard CAPM. This is what will happen if you have leverage constraint. How does that work in the data? So this is the original evidence from Black-Scholes and Jensen. This is the type of evidence that they show Wells Fargo, and again, they published later. This is the security market line for the US. This is using data for US stock from the 1920s, 30s to the 1960s. This is not our paper. This is Fisher Black. You could see the security market line was flatter at the time. So this is what the evidence that they showed Wells Fargo. To take advantage of this, you essentially have to short lower beta stocks and go long higher beta stocks and hedge out market exposure, and you'll earn this difference, essentially. Okay? So again, this is what the line looked like back then. This is what the look line looks now. Same idea, US stocks. This is just extended to now. You can see that the line is still flatter. It was flatter up until the 60s. It actually got even flatter in the subsequent 40 years. And academics have been sort of obsessed about this effect back in the 80s and the 90s. Famous paper by Fama in French that says the sentence, the CAPM is dead. What that means is this line in their sample is exactly flat. And that's, if you stop with 1992, that's exactly flat. If you extend it here, it gets a little upper slopey, but not much. But again, sort of flatter. OK, here's some evidence now outside of stock markets. Again, just like you can think about leverage aversion. Leverage aversion is a theory about investors. It has nothing to do with stocks or other or the particular instrument. That is, you would expect to see this effect in pretty much any asset market in which you do have leverage constrained investors. And fixed income market are a prime example of that. Many pension plans are not allowed to lever shorter dated securities in order to match longer dated liability. In fact, they match longer dated liability by buying longer dated, higher duration bond. They are the Franciscos of the world. So here's what happened in US Treasury markets. Again, you can see the same security market line that's flatter. Those are treasuries sorted by duration. That's basically the measure of beta in Treasury market. This is a security market line across asset classes. Just like you can look at a higher, lower beta or higher risk or riskier security within a market, you can look at a lower beta, higher beta asset classes. So in this particular case, the higher beta asset classes tend to be equities. The lower betas tend to be credit or fixed income. You see exactly the same. The security market line is actually flatter across asset classes. For those of you who are familiar with it, this is what underlines what people call risk parity portfolios, where Bridgewater and AQR were the largest provider of it. It's the fact that the security market line is flatter across the many asset classes. So I could do this in essentially lots of different markets, but instead of doing this, let me just do this with a portfolio that summarizes it. That is, I'm going to show you some evidence where we're going to test the hypothesis by essentially building a portfolio that is long the lower beta assets and short the higher beta assets and hedges out market exposures. And the way you hedge out market exposure is you're going a little more long than short, such as you actually have a zero beta. So for a US portfolio, or US stocks, for example, it means you're going to go long like $1 low beta stocks. You're going to short about 70 cents worth of high beta stocks, such as you're long and a short have the same beta, so it's a market neutral portfolios. According to the CAPM, that portfolio should have zero return because you're taking no risk. It's a riskless portfolio, has no beta. According to the leverage aversion hypothesis, you should earn this return, which is the Franciscos of the world paying you for letting them use the high beta asset as a subsequent for leverage. We have a name for it. We call BAB, or betting against beta portfolio. If you have some time later, I'll tell you some funny story about this name. There's no one here from Denmark. My co-author, Lasse Pedersen, is Danish. Well, it turns out that BAB, it's not a word that you want to use in Danish. And he didn't say anything up until we were actually speaking to a public pension plan in Denmark. And at some point, they had to tell us. And he failed to mention this. So you can call it BAB everywhere in the world, not in Denmark. In Denmark, call them long low beta, short eye beta. You can look it up. All right, so let me show you some evidence. It says here for more than 100,000 assets. It's a little bragging slide, but it's not bragging if it's true. There are actually 100,000 assets, so let me show them. The first picture here shows you, so on the y-axis, you have Sharpe ratios of these betting against beta portfolios. And they're essentially, those are within asset classes in a variety of different asset classes. The blue line shows you portfolios for equity markets. So the first line is for US stocks. This is what we've been known since the 1970s. Anything to the right of that is, again, completely out of sample, meaning not US stocks, over and not over the overlapping sample over the period subsequent to the 1970s. So the blue line on equity markets, those are the major markets belonging to the MSCI world. The red line are fixed income market, credit indexes, corporate bond, CDS. The green line are treasuries, and the other one to the right are asset class application, country bonds, FX, commodities, as well as equity index futures. So again, this is a wide variety of evidence that within asset classes, safer securities have higher risk-adjusted return than riskier securities. To the right, you can look at evidence across asset classes. Again, those are, instead of looking at stocks within the stock market, you're going to look at stocks versus bonds versus credit versus commodities. Again, you see the same higher Sharpe ratio. Those are different regions of the world. Those are evidence, again, Sharpe ratio of portfolio based on this effect within derivatives markets. So an example would be in equity options, index options, and those are the levered ETF that I mentioned before. This portfolio, it's really easy. You could do it within 10 seconds in Excel. Again, you're going to go long low beta asset and short high beta asset. So this is a portfolio that goes long an ETF and short 0.5 worth of the 2 times levered counterpart of that. That's all there is to it. Again, that compensation is the fact that investors are overpaying for that embedded leverage as opposed to doing the leverage themselves. And this is another type of application that is betting against beta portfolios within global market within each industry. So you're looking within each industry whether or not safer and riskier securities. So again, not to spend a lot of time with it, looking at this picture, it basically tells you that there's a wide variety of evidence across many asset classes that's consistent with Fisher-Black's hypothesis. Safer securities earn higher risk-adjusted return than riskier securities. There's some more evidence that I could show you, and that is, let me just show you this, is again, since we think this is related to leverage aversion or borrowing constraint, think of it as at times when there are going to be a lot of Franciscos around, all of these guys are going to bid the price up and expect the return is going to be very low. At times where there are no Franciscos around, or maybe they don't want a higher risk, you won't see this effect. And so if you look at proxies of credit markets or proxies of borrowing constraint, that should track return on those portfolios. This is an example of that. This is the inverse of the TED spread, which is on the red line. So minus the TED spread. And this is the average rolling return of a betting against beta portfolios within the US. And you don't have to be sort of a genius econometrician to see that those two lines sort of come move. That is, when credit constraints are binding, you tend to lose money if you are the Frazzinis of the world, and you lose money contemporaneously to make more money going forward, and vice versa when credit constraints are less bindings. I don't want to go too much into it. I want to go show you a couple of evidence. So first of all, again, we're looking at this evidence going back to the 60s, and at the time, we only had one measure of risk. So that was beta. That was sort of the CAPM was the major sort of risk asset pricing model back then. If you fast forward now, we do know there's lots of other type of, at least source of risk. So you can think of extending the low beta anomaly example to lots of other, great. lots of other type of example. Here's an example of that, which is what we call quality minus junk, which is basically our portfolios that are sorted not just on beta, but on a composite of lots of different measures of risk: leverage, profitability, credit risk, earnings volatility, lots of other sort of way of measuring how risky the company is. When you kind of see the same effect, that is, portfolios that are long safe and short risky actually have higher return, not lower return. And that's consistent with what I showed you before, just expanding this to lots of different type of evidence. You could do this globally, but, and this is sort of a picture that shows you, again, Sharpe ratios across the different markets of a portfolio that is long, safe, and short risk. All right, so let me just go back now and the last 15 minutes talk a little bit about holdings, and I want to talk a little about Buffett. Okay, so as I said before, one way to test this hypothesis is to go and look at what Frazzini's hold and what Francisco's hold. Well, the Francisco's of the world are pretty easy to find. So we need to find somebody that we know is leverage constrained, and we know, and for which we get to see the portfolio holdings. Pretty easy to do. Mutual funds. We know the mutual funds, many of them self-imposed and borrowing constraints. We have quarterly holdings. You can actually look up their holdings. So this picture here shows you the average beta of the entire US mutual fund sector from the holding between 1980 and now. You can see that the beta, it's about above 1. It's a little bit above 1. It's about 6% above 1, which is roughly matches the cash holding on the mutual fund sectors, which is what you would expect if you think of mutual funds are leverage constrained. You think of 6% as not being a big number. The size of that bar right now, it's about $14 trillion. So think of it, about 6% of it, it's distorted only due to the cash holdings of mutual fund. That's one type of investors in one market. I'm going to show you evidence in lots of different markets where there's lots of bigger investors than just mutual fund. So we got that right out of the way. Now let's look at the Frazzinis. Well, the Frazzinis of the world are much harder to measure, just because we need to find somebody for which we get to see portfolio holdings, but typically we don't get to observe the leverage. So think of Frazzini as AQR hedge fund managers. You get to see our quarterly portfolio holdings, we file holdings, but as a researcher, you don't actually get to see our leverage. There's no report, no public information about leverage. But it turns out there's only one corporate structure in the world for which you get to do that, and that's Warren Buffett. And why is that? Well, Berkshire Hathaway, it's a company. So being a company, they have a balance sheet, and having a balance sheet, you can directly observe their leverage. You know, their asset, their liability, their credit, their debt. There's no uncertainty. You can directly measure the underlying amount of leverage and the sources of leverage. And at the same time, Berkshire has to file quarterly holding, just like any large investor, so you get to see what they hold. So when you go and do that, you will find that Warren Buffett holds a portfolio that has a very low beta, about a 0.7 and 0.75 beta, and as I'm going to show you in a minute, uses a lot of leverage, using a very smart, very complicated, efficient source of leverage, but it uses leverage. So one way to think about the returns of Warren Buffett is that they've been doing what Fisher Blacks wanted Wells Fargo to be doing all along. That is, they're buying safer, lower beta, safer, lower volatility securities, and they're actually using leverage to lever that portfolio to the proper amount of risk, exactly what you would expect from basic finance. Fisher Black wanted Wells Fargo to lever to the same volatility of the market. I'm going to show you in a minute. Warren Buffett actually levers to a higher volatility. They actually more risk. It's about 40% or 50% higher. But the mechanism, again, taking safer security and levering. Think of it as an example of the Frazzinis of the world. So in the last 10 minutes, let me just talk a little bit about Warren Buffett. I'm not going to go through all of this, but I want to give you sort of a little bit of an idea. Again, Warren Buffett is not the richest man in the world, but he has been at some point one of the most successful investors, and someone who's also sort of puzzled academic researchers, because as much as we know that he's a very deep value investor, the return of a value factor don't really explain Buffett return. Explain part of it, but really there's a lot of what that was unexplained. So first of all, let's talk about Buffett track record. So usually when you ask, so we can use sort of the Sharpe ratio as an example of the track record. Usually when you ask people on the street, I guess provided that they know what the Sharpe ratio is, in Greenwich that can happen. I don't know about in general, but they will give you ridiculous numbers. What do you think Buffett's Sharpe ratio is? They will give you some ridiculous high 2, 3 actual numbers. The actual number is 0.76. The Sharpe ratio of Berkshire Hathaway between 1976, and in this case is 2012, is 0.76. That's the number. That's his Sharpe ratio. So is that a high or a low number, 0.76? Well, 0.76 is the highest Sharpe ratio ever reached by any stock traded in the US that survived for more than 30 years. That's an actual factual statement. You can see that in this picture. This is the Sharpe ratio every stock traded on CRSP for the 1920s. This is Warren Buffett. It's right there. It is the highest. There's no one lower, provided that you survive for 30 years. If you have to go back in time and you have to buy one stock only, and force you to only hold one securities, you would pick with perfect foresight Warren Buffett. Now you see where this is going. A 0.7 Sharpe ratio, it's high. It doesn't seem superhuman. It doesn't seem, just to give you a reference, the low beta anomaly that I showed you before has about a 1 Sharpe ratio gross. The market has about a 0.35 Sharpe ratio. So it's high, but it's not crazy high. So how do you become the richest man in the world? By having a 0.7 Sharpe ratio. I guess there's two ways. You start out very rich, which wasn't the case here. But the other way is just, it's leverage. The only way you convert a 0.7 Sharpe ratio into I am the richest man in the world, you have to lever up that 0.7 Sharpe ratio. And that's what I want to show you. So Buffett has been very sort of vocal about leverage in lots of his public speech, but it turns out that Berkshire does use a lot of leverage. And again, it's very easy to see. So this picture here is Berkshire Hathaway balance sheet. So what do they have? They have assets. They have a lot of cash. Publicly traded equities, those are their portfolios. And then privately held companies. Those are Geico's and reinsurance operations, NetJets, and the others. Obviously, they have liabilities as well as equity. So what is the leverage? You can look at total assets minus cash divided by equity. On average, that number is 1.6. That is, Berkshire Hathaway's levered about 1.6 to 1. For every dollar of asset or equity, they hold a $1.6 worth of stuff. Could be stock, could be private, but that's one measure of leverage. You can use another way of measuring leverage, that is the volatility of Berkshire Hathaway. It's about 25%, as I mentioned. The volatility of the stock that they own, which again, you get to see, it's about 17%. So the ratio of the two, it's about 1.4 or 1.5. So that's a measure of market leverage. So depending on what measure you like most, he's levered between 1.4 and 1.6. Now, where is the leverage coming from? If you zoom into one of his balance sheet, I don't want to go too much into it, but essentially it's coming from debt. So they're basically issuing bonds. They have AAA credit rated, they'll issue bonds. There's a complicated accounting trick that allows you to squeeze some leisure out of deferred income taxes. Don asked me to explain this. I've been explained, somebody explained it to me at least 15 times. I still don't get it, and I wrote 4 papers on it. But the main portion of leverage is coming from 2 components. One is the selling of derivatives, and that's exactly what you would think, which is another prediction of the Fisher-Black hypothesis, which I didn't mention. That is, if Franciscos of the world are out there and they want leverage, but they can't actually leverage, investors that can should be selling them leverage. And how you sell leverage? You sell derivatives, which have embedded leverage in it. That's a big part of what they do, selling options. Again, we have a paper on it. And the most part is what's called the reinsurance float, and that coming from the insurance operation. This is sort of the last part that I wanted to show you. So how does that work? Well, Berkshire Hathaway owns a lot of reinsurance operations, and the reinsurance operation is actually used as a source of leverage. And so you have a house in Florida, you buy insurance on your house, the insurance company holds policies on lots of different houses. They can reinsure part of the distribution of losses, usually the most extreme ones. So as a reinsurance, you are writing policies, you're collecting premiums every year, and then every once in a while, when a hurricane or a natural disaster or some other type of disaster hits, you have to pay out. And so what Berkshire Hathaway does, essentially, they're collecting reinsurance premium, and they're using that premium to buy stocks, securities. So you can think of it as reinsurance. The profitability of the reinsurance operation is their cost of capital. It is their cost of leverage. And Buffett is very, very proud of this, that he mentioned that in every single annual letter, to the point that actually it gives you the whole time series of the cost of capital, which you guys can see in this picture. This is from the 1970s to now. So if you look at the average leverage cost relative to T-bills, on average between the 1970s and now, and that number has been 3% below Treasury bills. Let me just let this number sink for a moment. We, as AQR levered hedge funds, we're borrowing at LIBOR plus some spread. They have been borrowing at T-bills minus 3%. So what that means is if they take the money and parked it into Treasury bill, they would have made 3% per year. But they didn't park it in treasury bill, as I showed you before. They parked it in higher quality, lower beta, safer securities that happen to do a lot better than treasury bill because of the presence of the Franciscos of the world, the low beta anomaly. Now you can ask, how is that possible? Well, it really just simply means that the average reinsurance operation are being profitable. Again, the cost of capital is you receive payments and you have to pay out. You have to pay out when a hurricane hits. If you receive more than you pay out, on average, your cost of capital, it's negative. And that's one of the beauty of this particular way of structuring. There is a very stable, low cost, in this case, negative cost, a way of financing that allows them essentially to lock in very long-term financing. They write very scary, very long-term reinsurance contracts, anything from nuclear disasters to gigantic sort of natural disasters to other type of disasters. So here's an example where we think we sort of have some understanding of the structure of the portfolio, that is you're buying safer, higher quality asset, and you have to use leverage, but this was done in a way that's extremely, I would say, sort of genius and smart. And this is not to say that you can replicate Buffett returns. Again, with hindsight, we're looking 40 years later with sort of full, perfect foresight. We're simply saying that there is something about those returns that correlated with what we think it's a pretty plausible explanation. So let me just conclude for one picture, and that is, you can actually try to do this formally. That is, you can ask the question, if I look at Buffett holdings, if I were to build a portfolio that instead of buying what I bought, simply bought stocks that have about the same characteristics, safer, high quality stocks, we happen to have a factor based on that, which is what I showed you before. We call it quality minus junk. You would see essentially this picture. Let's just look at here. This is a regression of Buffett returns on various factors. The first column shows you what academics have been puzzled for a very long time. That is, Buffett has a big loading on value, for big value investors, buy large cap stocks. It doesn't do anything on momentum, has a lower beta, as I showed you before, but has a huge alpha after you control for that. Well, it turns out if you add a portfolio of high quality stocks on the right-hand side, you get a huge loading on that, and the alpha essentially goes to zero. So again, what it really means is what they bought went ridiculously up, but it turns out if you bought a portfolio that is diversified, that has about the same characteristics, and you happen to use exactly the same leverage, again, complicated to achieve, but you would achieve about the same sort of the same returns. And you can see that in a picture. This is the overall stock market. The blue line, so the green line is Buffett, it's Berkshire, and the blue line, this is it's a fund that is actually tracking what Buffett does. It's a little more sophisticated, and this is a back test, that's why he does better. And usually people ask, how do you do better than Buffett? The answer is, it's a back test. So every back test will always look phenomenal relative to whatever you want to achieve. The point is, you have returns that are very correlated by simply holding a diversified portfolio of security that has similar sort of characteristics. All right, so let me just conclude. Oh, the one thing, sorry, that I just want to say is we wrote our paper, it's a little old, in 2011. What Buffett does after so we have to send it to Buffett. Buffett doesn't use email. You actually have to FedEx it, and your secretary sends you back a letter that says he received it, and it's a little complicated. But a little later, obviously unrelated to the paper, but he goes out and buys Heinz. And if you had to pick an example of what we've been talking about that really exemplified the whole thing, that's about Heinz. So Heinz has a beta of about 0.4, has a profitable, stable business, actually in the top 95 percentiles of most stable, higher profitable company in the US. And so, the transaction had a lot of leverage. In fact, in this particular case, Buffett partnered up with an external fund, 3G, in order to actually inject even more leverage. Again, very consistent with Fisher Black's idea, investors that can leverage should be buying safer securities and lever them up, either in a way that it's more efficient or less efficient, but they essentially should be taking advantage of the fact that there are Franciscos of the world that have constraints and they are distorting prices. So I showed you that in a world with leverage constraint, leverage averse investors can actually cause prices to be distorted. And there are lots of examples of this type of investors in many, many different markets. And I give you a little bit of flavor that Buffett portfolio is actually consistent with this idea and this theory. Not to say that he's following the theory, but it's also that one of the reasons why this portfolio does very well is because this distortion exists and they're actually very large. And with that, I know I went a little bit overboard, but we can take some questions if everybody wants to chat about any of this. Sure. 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 The way that you're right. There's going to be distribution. It depends of the variation in borrowing constraints. So think of it as the Francisco of the world cannot borrow. Now there's two components of that. One is a specific in investor-specific constraints. So mutual fund would be an example. There's other more complicated constraint that could be instead having to do with the securities. So for example, different securities might have different margin requirements. And so if we abstract from the margin requirements, the Franciscos of the world will concentrating around a portfolio that tends to be risky, and some proxy for the dispersion of the borrowing constraints should actually predict that. And that's something that we do show in the paper. That is, there's something called beta compression. That is, think of it as when market drops by a lot, people say correlations go to 1. Really mean betas are going to 1. And one of the reasons why that beta compression happens is because if the leverage constraint becomes more binding, then lots of people become like Franciscos and they buy the similar type of security. So we have, in our JFE paper, we have some evidence that's consistent with that. Right, so think of it as before there's only one Francisco and everybody else is unconstrained. And then tomorrow, margin constraint become very binding, and now all of you becomes constrained. I'm the only one that becomes less unconstrained. The dispersion, you guys are all going to buy very higher beta securities. I have to take the other side. If not big enough, prices will move. And then you can, and that's a testable prediction. So provided that you have a proxy for how many Franciscos of the world out there. Now the TED spread might not be the best proxy, and I agree. There's other people that have looked at lots of other proxies after. At the time, that was sort of the only one that we used, but there is other type of proxy that you can use.
Okay. The second question is that then the business of the insurance companies is a very good business because they collect this premium and they can invest in the stock market, for example.
Well, that's true. The reinsurance business is a phenomenal business. There's a couple of things to know. It's phenomenal for two reasons. First of all, because reinsurance, your returns for insurance depend on the occurrence of whatever you're insuring, so natural disaster, a type of disaster. And fortunately, those type of things are not very correlated with stock markets or bond markets or commodity markets. This is the probability of a hurricane hitting Florida. It's pretty stable over time. It doesn't really depend on the S&P 500 returns. And therefore, it's a type of risk that lots of investors like us will love to hold. It's risky, but it's very uncorrelated. At the same time, it's a very opaque and very hard to entry markets. The fixed costs and the setup costs are huge. And therefore, it's very hard to scale. It's not an efficient market at all. Buffett is definitely the largest reinsurer in the world, and there are huge economies of scale. There's a long way to say that. If we have an insurance operation, for example, we can't get as close to their sizes just because we're not as big to begin with, and that's a very big barrier to entry. Sure.
Thank you, Andrea. My question is regarding the consistency of the anomaly going forward. So there's been a lot of investors who have bought in reinsurance businesses, such as Monish Pravarai, AQR, and perhaps one of the hedge funds that have raised reinsurance businesses in order to achieve perhaps this leverage. How many more investors can the market sustain in order for the anomaly to keep being an anomaly and not being eliminated? Sure.
So what I would say is first of all, this is a particular example for which we actually get to observe the other side, or at least have some proxy for the other side. So again, the reinsurance part, that's how to get an efficient leverage. But it's not necessary. You could do this with normal leverage. You do better if you use reinsurance type of leverage, but suppose you just use normal leverage. How big these anomalies can be, it really depends on how big the Franciscos of the world are. The bigger they are, the larger the anomaly is. Now, again, this is an example where, think about lots of other anomalies, in value, momentum, and others. You don't really have it. If you ask me who's the natural momentum investors that is buying these low momentum stocks that you're selling and selling you the high momentum stock, I don't have I don't know where to look. But I know where to look to find the Francisco's guys. And so far, the Francisco's are big. So think of it as the share of the, just in stocks, the shares of market that's held by institutional investors with long-only leverage constraint or mutual funds just been growing over time. So as I show you the picture, the anomaly is getting worse. The security flattening means you make more money now than you did in the 1960s. And in fact, now in some markets, even inverted. So in some sense, again, this is not an arbitrage. This is a risky portfolio, and there are periods in which you lose a lot of money, and that also is part of why this persists for a long time. But the anomaly will, I guess, persist as long as there is at a limited capital take advantage of it, or there's people like Francisco, there are constraints.
Yeah, so how is this related to rare event risk? The way I'm thinking about it is that, when you lever up, with normal distributions, of course, levering up is exactly the same as not levering up. But if you have non-normal distributions, you can lose more than your capital if you borrow money, but you can't if you just invest your capital. So perhaps you have high returns because these levered portfolios are levered on some rare event risk or something.
Oh, sure.
Like that.
So that's actually possible. That is, think of it as you can have a variety of reasons why you see this. So first of all, you need to have, let's say, even according to the Franciscos of the world. And then why is that the Frazinis of the world size isn't infinite? Like, why am I not borrowing an infinite amount and just, even if Francisco is very big, I am actually huge. Rare events could be an example. That is, in order to take advantage of this, you actually have to leverage. And that involves real costs, managing on leverage, and lots of other real world limits to arbitrage constraint. Rare event could be an example of that. The point is the compensations. The bond example is a very good example. That picture that I showed you with the security market line flattened, this was from the 1950s. So this means that if you were long-term bond investors and you want to match 30 years liability, on average, from the 1950s to now, it would have been optimal to take 1-year bond and lever them 30-to-1 to match the 30-year liability. In practice, no. So you have some convexity mismatch, but you get way more compensated from that. But in practice, no investors will ever do that, at least pension plan investors, because you have lots of risk and you can have sort of event-based risk. So I would call that a limits to arbitrage. One of the reasons why it's actually hard to arbitrage this.
So I have a question. So given that you mentioned me so many times, I feel like I sort of have a right to say something. So the Franciscos of the world would actually do corporate finance. And so the natural corporate finance question is why is it that the guys in iBanking are not telling the firms to lever up?
Okay.
So naturally, if you sell leveraged securities, you're going to get a higher price. So it seems like there is also an opportunity in iBanking to pursue this.
That's right. So that's a very good point. So Fisher Black actually had that specific hypothesis, not in the original paper in the 70s, but in 1992. So the idea being, if I'm a lower beta stocks, I have a low price and a high returns, I have an incentive to simply issue debt and do the leverage. So again, the low beta anomaly means investors can lever. So Frazzini comes in and does it for them. But I'm not the natural arbitrageur. The natural arbitrageur is the company that can actually issue that. So Malcolm Baker and Jeff Berger have some work on it that's related. Now, it's hard to see in practice. That is, it kind of goes in the opposite of typical corporate finance wisdom. That is, we know the companies don't issue debt enough. And this is another reason why they should issue sort of more debt. But that's definitely true.
I have one more for the anecdotal value. We can come out of this meeting and say something in our talks. And probably it was in the regression that you made before. What's the let's say, how much of the extra return that Buffett has been making over the last 40 years or 50 years, how much can that be attributable to using this kind of leverage BAB-like strategies?
Well, I mean, it's hard to answer. It depends on how much you let me put it this way. In some portfolios, is a lot of it. So let's say risk parity-based portfolios. That is actually the only driver of risk parity portfolios. 100% of that is due to this. And in lots of other places, it could be a small part because that's one friction, but there are hundreds of different frictions. Think of it as what I've been describing today is it's not the way we think the whole world works. It's one friction, but there's lots of other type of friction that can cause distortion. This is a particularly big one, but it's hard to gauge how much we would have generated returns. Now, there's a whole business now, which is the low defensive, low volatility type of business, with lots of ETFs, lots of indices. That's essentially this. 100% of that will be due to this, but there's lots of other places where this could be a small portion.
Great. And a secondary question: how eroded can these strategies be or become after, for instance, having market participants like high frequency traders or these kind of guys who take advantage or try to take advantage of these sudden moves? I mean, they're probably more linked to momentum strategies or things like that, but still, they might use this kind of
sure.
of effect.
So this is an example of actually that should not be a big problem, just because those are very, I didn't mention this, but this type of portfolios, they're very, very slow moving, very sort of, when we're talking about sort of betas move around, but think about when I'm talking about companies that are safer versus risky, it's really not about their stock price. This is about their business, whether or not their earnings are volatile, they're correlated with business cycles and things like that. Now, high-frequency arbitrageurs can impede arbitrageurs or try to take advantage of that by front-running their trade. That will always happen. But I wouldn't say that this is something that will go away because of that. There's lots of other distortion that will go away because of high-frequency trading strategy, event-driven type of things that might be very effective, but not this one. And especially not in stock market. That's an example. But again, I show you evidence on lots of different markets and in many other markets where high frequency is not really a prevalent part of the market.
I have a question. So last year we had another paper that was trying basically to explain your betting against beta, and they claim, well, it's not really about leverage; it's about lottery-like features in the stocks. Can you comment on that?
Oh yeah. So what I would say is, I would say two things. First of all, a lottery preference is a special case of the beta of the leverage aversion, unless you make a specific example. So what does that mean? In lottery, it means that I like companies that are very skewed, that are a small chance of a very big returns. And so the lottery preference says, well, people are going to like the 2 beta stocks versus the 1 beta stock because you get twice the possibility of higher returns. Well, I can always take a 1 beta stock and lever 10 to 1 and make it a 10 beta stocks. I will have the same high probability of winning. The difference is I'll have downside. And so you have to add a very specific assumption, that is, people like the lottery and hate the downside. But I will call that a measure of leverage aversion. You want to win a lot, but you don't want to lose more than your initial capital. So it's hard to distinguish between the two. It's definitely part of it could be due to this type of lottery. So again, it depends on what you call it. But part of it could be due to lottery. But it's hard to say it's 100% one, 100% and 100% the other. There is one way to distinguish the two hypotheses, and that's looking at volatility versus correlation. The beta anomaly is really about correlations. When you're moving the market, the lottery is more about volatility of the individual equities. So that would be a way to do it, but that's, I haven't seen it done yet.
Thanks. I didn't quite fully understand the leverage story, but it's okay. What struck me most was, and something you said was quite obvious, it wasn't obvious to me, that the higher beta stocks had higher volatility. You said that's obvious, and why is that? I couldn't quite follow that.
Oh, it means they just move, they can move more with the market. And but
there's also correlation, and then there's volatility, so the betas should also be based on correlation, right?
Well, think of the volatility of the stocks depends on the beta, and then depends on how much the idiosyncratic volatility. If the idiosyncratic volatility is about the same, then higher beta will have a higher vol. So it's not mechanically true, but you would expect that to be true. In some market, it will be mechanically true. So in bond market, for example, beta is really duration, and that's really always true. High duration bonds are more volatile than low duration bonds. They're riskier. They are longer term cash flows. In the stock market, it's not necessarily true, but it is true in practice.
Okay, I was wondering if it could be that the high beta stocks are attracting investments from speculators, et cetera, and causing higher volatility or something like that.
Oh, that could be. So that could be, but that's about the idiosyncratic volatility. That's also true. That is, think of it, high beta stocks are more speculative, but just mechanically, the way you define the beta really just means that on average, if the market is more volatile, they'll move more with it.
Okay. So thank you very much, Andrea. Thank you for coming, and thank you for this presentation.
Thank you for having me. Thanks.